Okay, stakeholders. So we'll start with the definition of stakeholders. Anyone who affects or is affected from the business. Now these can be individuals or groups, and they can be inside the company or outside the company. There's definitely more external stakeholders than there are internal stakeholders. So internal stakeholders, we've got the owner, the person who's the entrepreneur, and potentially anybody who's invested their money into it. We've got managers, maybe called directors, but they're people who are making strategic decisions higher up in the hierarchy. We've got employees, we could call these operatives, people who are actually doing the day-to-day tasks of the business, and they all want different things from the business. Owner, we're going to assume probably most of the time is a profit maximizer, and they want return on their investment. Managers, they want job security, they want maybe promotional prospects, and they want good salary. Employees, they want job security, good salary. External stakeholders. Okay, so these are people who obviously affect us or are affected by the business, but aren't working within our company. The suppliers, people where we buy our raw materials or any components we need for our business. We've got the local community. So the local community from us, what they want us to be, maybe provide jobs to the local community, but also for the business to behave in the right way. Don't have lorries driving through the town at 2 a.m. and things like that. What do the suppliers want from us? The suppliers want regular orders, payment on time. Banks will be lending us money, they'll be letting us deposit money in our business bank account. What do they want from us? They want us to use their financial services and ultimately pay interest on that, whether that's the credit cards, whether that's paying back loans with interest. Government's affected by our business and they affect us, so they'll affect us through making regulations and policies that we need to implement, and we affect them because we'll owe them tax, whether that's value-added tax on the goods and services we sell or corporation tax on the profits that we make. Pressure groups, these are non-profit organisations who try and influence various activities. So they'll have their own objectives and they can be very varied, but what they'll try and do is affect our behaviour to be more ethical to whichever their aim is. And customers, what do they want from us? They want good quality products at reasonable value. Okay, so quality being a key issue there. Now, the way this sort of goes in exams often is actually having a discussion, a evaluative question about conflicting objectives. And most of the time, I think stakeholders conflict with the owners. And I've tried to illustrate here why. Owners, as I said, are often profit maximizers. They want to make as much profit as possible to increase their wealth. So, employees, why does that conflict with an employee? Well, I said the employees, what do they want from the company is basically a good salary and job security. Well, the owners, if they're having a high salary, that will actually increase their costs. Profit maximizers, they want to keep costs as low as possible. So there's a conflict there. Customers, they want good quality products at good value. Well, being a profit maximizer, we want to keep costs low, we want to keep prices high. So that's to increase the quality, we're going to need to increase our cost of production. And to increase our revenue, we're going to need to increase our prices, and they don't want that, so there's conflict there. Pressure groups want us to behave ethically, but often ethical behaviour results in increased costs for a business, whether it's disposing of your waste in an environmentally friendly way, using recyclable packaging, no plastics in your packaging, whether that's making sure you're paying your workers a fair amount. All of those things are just increasing our costs, which conflicts with profit maximisation objective. So after I present my argument here, why there is a conflict, I found the conflict in the case study and I've analysed why that conflict is a problem, I then need to evaluate it. So sometimes these conflicts actually aren't as bad as potentially we think. I mean, I've looked at the first one there about employees. Employees may be more productive with higher pay. Okay, so that'll actually decrease our costs. If we pay them more, well, not decrease costs, but actually increase our revenue. If they're producing more output, we're able to sell more products. Second one, the customers. Higher profits could lead to innovative products. Yeah, in the long run, we actually could be making huge profits, developing our products, and benefiting customers with future models which are more technological. I don't really think customers necessarily agree with that evaluation point, but I definitely can put it out there as something to critique what I've said earlier. And the last one about pressure groups. Often businesses behave in an ethical way, which means we don't conflict with pressure groups, And what this actually does is it increases brand loyalty, we can charge higher prices, we avoid maybe fines from the government, but essentially we can actually end up being profit maximisers by being ethical if consumers are reacting to our ethical behaviour. And that is probably the most common exam questions you'll get on stakeholders, their conflicting objectives.